When you look at Chery Auto, you see a real powerhouse in the global automotive market. I mean, they're consistently a top seller. But then you look at how the capital markets see them, and there's this major disconnect. So today, we're going to deconstruct that valuation puzzle and really dig into the story of a sales champion that's, wrestling with some serious investor skepticism. So what's really at the heart of this? Well, it boils down to three core tensions. First, you've got this massive gap between their top-tier sales numbers and their lagging market valuation. Second, there's the contrast between a booming, very successful export business and, frankly, weak overall profitability. And third, you have this paradox: explosive growth that's being funded by some pretty high-risk financial leverage. These are the key variables that are really going to define Chery's future.
All right, let's start with Section 1, looking at the growth engine here. To understand Chery's performance, you really have to look at the two forces that are fueling its momentum: a commanding global presence and a really aggressive push into electrification. And the results? They speak for themselves. In the first quarter of 2025, Chery's net profit shot up by nearly 91% compared to the year before. I mean, that's a huge number. Growth like that points to some powerful operational leverage and a very successful expansion strategy.
Now, if we break down Chery's position back in its home market, you see this really interesting two-sided strategy. They're number 3 in total vehicle sales, sure, but look closer. They are number 1, the top dog in traditional fuel vehicles. That segment is their rock, a stable, profitable foundation that's funding everything else. Meanwhile, in the new energy space, they're a challenger, sitting at number 5. That's where all the future growth and investment is going.
And you can see this strategic pivot isn't just talk. It is fundamentally reshaping the company's revenue. By the first quarter of 2025, new energy vehicles were already making up over 30% of their passenger vehicle revenue. This isn't some slow, gradual transition. It's a rapid, and you could say, decisive shift into the future of mobility. Now, a huge catalyst for this shift is the strategic alliance with the tech giant Huawei. Their collaboration on the high-end Luxeed brand is all about integrating that cutting-edge, smart driving and intelligent cockpit tech. This partnership is absolutely crucial if Chery wants to break into that premium, tech-heavy EV market.
Okay, so that's the growth story. But, and this is a big but, this kind of aggressive strategy brings with it a pretty serious set of risks. So now we have to turn to the other side of the equation. That brings us to Section 2, the 3 major challenges: profit, leverage, and competition.
The first challenge is profitability. Despite all that sales volume, Chery's gross margin was just 12.4% in the first quarter. That's the lowest among its key competitors, who are averaging almost 18%. This tells us that Chery is just not as efficient at turning a sale into actual profit compared to its peers.
So, where is this margin pressure coming from? Well, it's that big pivot to new energy vehicles. The gross margin on its NEVs is a razor-thin 5.7%, which is worlds away from the much healthier 14.4% they get on their traditional cars. What this means is, as NEV sales go up, they're actually dragging down the company's overall profitability. And that profit problem is made even worse by the second major challenge: debt. Chery's asset-liability ratio is sitting at 87.7%. That is significantly higher than the competitor average of around 67%. This really indicates that the company is operating with a very thin safety margin and a whole lot of financial risk.
You see, all that debt, it acts like a strategic straitjacket. In an industry that's known for brutal price wars, having a strong balance sheet is a massive competitive weapon. With a liquidity ratio below 1, Chery has very limited room to maneuver, to slash margins to gain market share, especially when compared to its more financially stable rivals.
And this puts their entire strategy in a tough spot. The whole idea, right, was that the profitable export business, powered by those high-margin fuel cars, would bankroll the transition to NEVs. But as this quote puts it so well, when your NEV margins are practically zero, that profit engine is in danger of becoming just a subsidy to cover losses, not a true investment in a profitable future.
And just to make things even more complicated, that very profit engine is now under attack. For 22 years, Chery has been the undisputed king of Chinese auto exports, but its competitive moat, it's now under siege. Those international markets that were once their private blue ocean of easy profits are quickly turning red as every single major rival, armed with strong brands and deep pockets, is speeding up their own global expansion.
So, pulling all of this together, we arrive at our synthesis in Section 3, the key variables. Chery's future success isn't a given. It really hinges on how they navigate 3 specific, very difficult tests that are going to determine if they can create sustainable value.
So management is really facing a triple test here. First, they absolutely have to fix the profitability problem in their new energy vehicle business. Second, they've got to deleverage that balance sheet to get some strategic flexibility back. And third, they must defend that overseas moat from this new wave of powerful competitors. How the company performs on these three fronts will really define its path for the next decade.
And this brings us back to the ultimate question. Chery has proven, beyond a doubt, that it can sell an incredible number of cars on a global scale. But can that amazing volume be translated into the kind of profitability, financial stability, and durable competitive advantages that the capital markets demand for long-term value creation? Well, that is the billion-dollar equation that is yet to be solved.